Good afternoon. Welcome to today's Charity Village webinar. We will just wait a moment for everyone to join the session. Okay, we will get started. Welcome to today's Charity Village webinar. My name is Mercedes Marap, and I'm the Marketing and Communications Specialist with Charity Village. As we are gathering here in a virtual platform, it is important to acknowledge that each of us is joining this webinar from the ancestral or unceded lands of the Inuit, Métis, and First Nation people. As a settler on this land, I'd like to acknowledge that I'm speaking to you from the traditional, ancestral, and unceded territory of the Anishinaabe, which includes the Ojibwe of Fort William First Nation. For those who may be joining a Charity Village webinar for the first time, Charity Village is Canada's largest online job board for the nonprofit sector. In addition to our online job board, organizations can also post volunteer positions. So if you're looking for work or to recruit talent in the sector, Charity Village is the place to start. We also have a ton of excellent resources for nonprofit professionals, including online courses, articles, fundraising tools, and free webinars like the one we are presenting today. Before we start today's webinar, I would like to quickly run through some housekeeping items. You may have noticed when you joined the webinar today that you were automatically put on mute. Since we have hundreds of participants in today's session, it is important for us to minimize the amount of background noise so everyone can clearly hear the presentation. But you can still ask questions and make comments using the question box at the bottom of the Zoom control panel. Look for that at the bottom of your screen. We will be taking questions at the end of the webinar, so please submit your questions as you think of them, and we will do our best to get to as many as possible. You can also email your questions to webinars@charityvillage.com. If you happen to encounter any technical issues with the webinar, whether with viewing the presentation or with the audio, please let us know in the question box or by sending us an email. We will do our best to get any technical difficulties resolved as quickly as possible, but in a worst case scenario, please remember that we are recording today's webinar and we will send you the full recording by email tomorrow. So if you get called away or disconnected, you will still be able to view the full presentation. And with that, I'd like to welcome our presenters, Kecser and Shirley Wolff from Enkel.
Thank you, Mercedes. We are so happy to have you here. I'm going to start and introduce Enkel to you. If you haven't heard of Enkel already, we are based in Vancouver, BC. And I'd like to start off by acknowledging that our offices are situated on the unceded traditional territories of the Musqueam, Squamish, and Tsleil-Waututh nations. Enkel is based in Vancouver, BC, like I said, and we have a nonprofit division where we work with over 100 NPOs and charities across Canada, providing outsourced bookkeeping, like accounts payable, accounts receivable, payroll, and controllership services, where we can help you with your grant applications and so forth. Our agenda today is providing a general background on information on audits and industry trends, the importance of year-end reporting processes, things to look out for during that year-end reporting process, meaningful reports for your board, some important changes in 2023, what you need to provide to your year-end accountant, and what you need to provide to your board, technology and tools that simplify year-end reporting and audits, and what to expect if you're getting audited. And what do you owe the CRA? CRA being Canada Revenue Agency. We're going to kick off today with a polling question. So on a scale of 1 to 10, rate your level of stress during audit season. And I can actually see the results here. We're just going to give a few seconds for everyone to rate their level of stress, because our hope today is to help lower that stress. Knowledge is power. So the more you know about what you can expect and how to be successful during your audit, hopefully that stress level is going to go right down. So we're seeing a 10, about 6% of people. The highest is about a 7. So that's pretty high. We're seeing that the majority of people here are between a 5 and a 7 for stress related to your audit. So our goal today is to help you with that. Okay, let's talk about a little bit of background. Why does your organization need a year-end audit? So it might be required by jurisdiction. So if you're Canada not-for-profit, the Canada Not-for-Profit Corporations Act requires that your bylaws might require it. You might have contractual arrangements. So some of your funders or lenders may require it, and that we see that quite often. It also demonstrates integrity in the numbers for decision-making purposes. So it's that extra layer of integrity and accountability. It demonstrates appropriate stewardship of funds. It asserts whether funds were spent as intended by donors or funders, and it provides an added layer of risk management. And that's what really sets apart the nonprofit sector, is we are stewards of money that doesn't belong to us. It's not like business where we're making sales and then we can spend it any way that we want. So that extra layer of being audited really provides transparency. That's really important in the sector. What are the general trends that we're seeing? We're seeing audit fees increase due to the rising cost of doing business and changes in audit standards impacting the scope of work. So we're seeing this quite often where the standards have changed, and of course, the fees are aligned with those changes. Personnel shortages leading to delays in getting the audit started and completed. Pandemic might be a part of that, or it's just happening. We're seeing more and more, where we're seeing a lot of turnover with personnel. Additional billing due to lack of preparedness for the audit. So have you ever received that extra bill from your auditor for extra bookkeeping or having to reconcile or fix different entries? Limited tolerance for changes once the audit process begins. So these are the general trends that we see. And we really wanted to add a section here for terminology. I think we get really caught up in what I call accountees, which is language where, those of us that are in accounting will go back and forth with some terminology. But sometimes it's, people sit back and say, what is a PBC? Isn't that what we used to watch cartoons on when we were kids? So PBC is a list that your auditor sends for you or your bookkeeper or your outside bookkeeping company to prepare for the audit. It will have things like compiling your bank statements, compiling your deferred revenue schedule, etc. So that kicks off the audit. Revenue recognition. What does that mean? So that is tied to revenue and deferred revenue, and really ensuring that if we're looking at, for example, the 2022 year, that everything that's in 2022 belongs to 2022. So if you have a large amount of funding that's come in, you haven't spent it all in 2022, how much are we recognizing this year and how much are we deferring to next year? Have you heard anyone ask you for an accrued liability schedule? Some people are sitting here likely nodding and saying, I know what all of this is. And other people might say, I don't know what that is. So accrued liabilities it represents expenses that we know belong to 2022, but you haven't received the bill yet. And a great example of that is your audit bill. Your audit bill, if your year end is say December 31st, belongs to 2022. But because your audit is not actually happening until maybe March or April, you're not going to get billed until 2023. So we accrue for that expense. Materiality is a basis that your auditor will set, and it's a threshold for which anything under that threshold, and it's a dollar value, is considered immaterial, or they're not going to dive deep into it. So if your bank account is out by 56 cents, that's likely immaterial. Well, it is immaterial. Significant risks. So we will talk about that as well. But these are very common terminologies that you will hear in audit. And we do talk a lot about risk with audit. Why does good bookkeeping and record keeping matter? Well, less planning and adjusting required at year end. So there's an old saying that says failing to prepare is preparing to fail. So the more that you can plan, the less adjustments at year end. Greater trust in the numbers, which may translate into less scrutiny and testing. Fewer adjustments from the auditor generally translates to lower fees and less time to complete the audit. So the more the auditor has to go in and fix your books, the higher your fees. And we're trying to limit surprises at the audit. So changes to bookkeeping records can result in management and the board having to adjust expectations and plans. Limiting surprises can also mean that previous assumptions were incorrect. Oh, we've got another polling question. So I'm looking to you. On a scale of 1 to 10, how prepared are you for your upcoming audit? Your year end might be March, might have been in December. How prepared are you? Now, I can't see the results of this one, so I'm going to rely on Charity Village to give me the results, please.
Yes, we are just receiving the results as we speak. So I will just wait for a few more people to participate and then I will read the results off to you.
Great. And just to reiterate, 10 would be very prepared. So 0 would be not at all, or 1 would be not at all prepared. 10 would be very prepared. So let's see how prepared you are going into the audit season.
About 5% have indicated that they are very prepared at a 10. 14% have indicated that they're at a 9, and it looks like about a quarter have indicated that they are at an 8. So it looks like quite a few people are saying that they are quite prepared. However, we do have a lot of people also hovering around the 5 to 7 range at this point. So people are looking for more information about auditing and just to streamline that process for them. So
excellent. Thank you, Mercedes. All right, let's talk about year-end reporting. So we talked about that PBC checklist that the auditor sends. What's a typical year-end checklist? So what are we talking about overall with audits? We want to develop deadlines for the close of the year. Okay, so we want to know when are we going to have all of the invoices and all of the revenue in that belong to the year. So we want to close off the year. We want to compile all documents, digital, hard copy, keep our transactions up to date in your accounting software. You want to make sure that you're tracking all of your tax receipts, and you want to be aware if you're getting an audit, a review, or a notice to reader. In the nonprofit sector, we primarily see audits and some reviews. Confirm with your auditor what your audit plan and timeline is. So your planning has to align with their planning. Brief your internal team on the audit and what their responsibilities are going to be during the audit process. Share your draft audit financials with leadership and the board. And then you're going to want to finalize the financial statements and prepare for your required filings to the government. Then we prepare financial summaries to be included in an annual report if that is applicable to your organization. Other things to look out for during the year-end reporting process include credit card and bank account reconciliations. A lot of times we see that banks might be reconciled, but credit cards haven't been. You want to make sure that everything on your balance sheet is reconciled before the audit begins. Your schedules for your statement of financial position, which is also known as your balance sheet, all of the schedules. So whether that is your prepaid schedule, your capitalization schedule, your capital asset schedule, your accrued liability schedule, your deferred revenue, all of those schedules need to be up to date and reconciled. Your donation types and imposed restrictions on any type of revenue are all reconciled. Your allocation of expenses, including administrative expenses, have been properly aligned to your restricted programs, and your reporting to funders is all up to date. What are some important reports for your board. The annual financial statements, the auditor's report on the audit plan and the results of the audit need to be shared with your board, your budget report, your cash flow forecast, and your financial forecast. Now I'm going to turn this over to Shirley, who's going to be talking about some important changes that have come in 2023.
Well, thank you, Christine. And we're now switching over to the topic of the changes in accounting standards that are applicable for fiscal years beginning on or after January the 1st, 2022. So if you have a December 31, 2022 or March 31, 2023 year end, these standards and these changes will apply to you. But some good news is that there are actually few changes that you need to consider. The Accounting Standards Board issued a new section 4449, which deals with combinations by not-for-profit organizations. And this is applicable for new combinations that are entered into on or after January the 1st, 2022. This means that you don't have to go back and restate your financial statements for transactions that have occurred in the past. You may be wondering what a combination is. So it's either a merger or an acquisition of one or more not-for-profit organizations that may be related or unrelated organizations. Transactions that are outside of the scope of the standard include an acquisition of a for-profit entity by a not-for-profit organization, a contribution of a for-profit entity to a not-for-profit organization, and a formation of a joint venture. So this new standard provides guidance on determining whether the combination is a merger or an acquisition, and how to recognize and initially measure the transaction, and what information to disclose in your financial statements. The Accounting Standards Board also issued a new accounting guideline for customers accounting for cloud computing arrangements. And this guideline will actually be found in the Accounting Standards for Private Enterprises. But the board also changed the scope of section 4434 to include this new guideline. And so that essentially means that this guideline also applies to not-for-profit organizations. It provides guidance to determine whether the costs that relate to a software intangible asset or a service need to be treated, and also how to treat related implementation costs. And it also outlines several accounting policy choices that are available. Now, with respect to this guideline, it's actually effective from January the 1st, 2024. But it does have to be applied retrospectively. And since we're now in March 2023, January the 1st, 2024 is in fact just 9 months away. And it's always good to prepare for the adoption of new accounting standards and guidelines as soon as possible. So we're now looking at changes to auditing standards. So the Auditing and Assurance Standards Board in Canada has also been busy. CAS 315, which deals with identifying and assessing the risks of material misstatement, has been revised. And the revisions are applicable for audits of financial statements beginning on or after December the 15th, 2021. So again, as we look at year ends of December the 31st, 2022 and March 31st, 2023, these will be applicable. So things that you can expect that are different from previous years is that auditors will be performing a more robust risk identification and assessment. So of course, a risk assessment process has always been important in every audit that's been done in the past, but far more effort and documentation will be required under this revised standard. Technology has formed an increasingly important role in each audit that's been done, and the standard has also been amended just to require that increased focus on information technology, both as it's applied during the audit and also as it's actually applied within the entities that are being audited. And it also extends to understanding and auditing what are referred to as general IT controls. There are also enhanced requirements related to exercising and documenting how the auditors have used professional skepticism during the audit. So professional skepticism is really a mindset that the auditors come with when they approach an audit. They neither assume that the information being audited is incorrect, but neither do they assume that it's correct. They need to get unbiased audit evidence to support the conclusions that they reach during the course of the audit. And the standard also includes a recognition of the scalability of the risk assessment process based on the size, nature, and complexity of the entity that's being audited. So of course, one would expect a more robust risk assessment if one is auditing a larger and more complex entity. As Christine mentioned, your auditors will provide you with a PBC list. So that essentially stands for a prepared by client list. And additional information and source documents will also be requested during the audit field work. The initial PBC list will likely include items such as your trial balance, after all the year-end entries have been posted. And examples of some of those year-end entries would be updating your accrued liabilities and recognizing amortization on your capital assets. They'll also need a general ledger, which provides a detailed listing of the transactions for each account. The bank and credit card reconciliations and statements, an accounts payable listing. So this should be provided at a detailed level so that the auditors can actually see not only the vendors, but the invoices as well, and the dates of the invoices, and preferably an age listing as well. Similarly, they'll also want to see an accounts receivable listing. So this should also be detailed with the customer invoices visible. There will also need to be supporting schedules for other statement of financial position accounts, such as a deferred contributions continuity schedule, which will also support the disclosures that need to be included in your financial statements if you're using the deferral method of recognizing contributions. The accrued liabilities list, also identifying the composition of the account, as opposed to just a transaction listing. A capital assets continuity schedule as well, showing the opening balances for the cost and accumulated depreciation accounts, and also the changes that have occurred during the course of the year in those accounts, such as additions to capital assets and the depreciation that's been recorded. Just a tip for you is I always recommend that you encourage auditors to make this list as complete as possible and to provide it as early in the process as possible as well, because this will allow you ample time to gather the requested information. And it will also help reduce the amount of information that's requested during the audit field work, because this is always a very busy time. You may also wish to discuss the format of the requested information with the auditor, as this can also reduce the amount of audit effort and cost. Generally, auditors will ask for the information to be provided electronically, such as in an Excel spreadsheet. You may also want to consider asking the audit to provide you with that PBC list in Excel or perhaps a Google Sheet, because this will allow you to allocate responsibilities for gathering information internally amongst the people in your finance department, And this is sometimes easier to do than if you receive the PVC list in a letter format or in a PDF format. We're now going to look at what you can expect before and during the audit. So before the audit fieldwork begins, auditors need to meet with those charged with governance. So this would typically be a finance committee or perhaps a finance and audit committee, or if you don't have a committee established, it would be with the board of directors themselves. And this would be to present the report on their audit plan. And then, of course, at the conclusion of the audit, they would also meet to present the results of their audit. We also recommend that you set up the finance committee or the board of directors meetings with the auditors well in advance of those meeting dates. Of course, you also want to check your numbers and make sure your books are up to date and ready to pass on to the auditors. You'll definitely help reduce the audit effort and costs if all of the year-end entries are posted before that trial balance is provided to the auditors. It's also a good idea to meet with the auditors for a pre-audit meeting, perhaps several months ahead of your year end. And this is an opportunity for you to set and review the expectations that you have of your auditors and also that your auditors have of you. It's also a good opportunity to update your auditors on any significant transactions or events that have occurred during the year, and also changes such as personnel and system changes, and any other information that you feel is relevant to the auditors. Other topics to discuss would include the PVC list, the timing of the audit, the deadlines, and the deliverables. It's also a great time to review past audits, to look at what went well and what perhaps didn't go well, and what you need to do for the current year audit to really facilitate a smoother process. You'll then, of course, want to gather the documents that are required for the audit. And the auditors will need to focus on your business processes, IT systems, and internal controls. A best practice is to document the organization's policies, processes, and internal controls if you haven't had the chance to do that yet, or also to update the documentation when changes occur. It's also important to ensure that there's evidence for the performance of the controls, because the auditors will be focusing on all of the controls that they believe are key to the financial reporting process. They'll want to ensure that those controls have been appropriately designed, but they also want to see whether they have been implemented. So, for example, one of your controls is to review a bank reconciliation. Think about what evidence you can provide to your auditors to demonstrate the fact that the bank reconciliations have been reviewed during the course of the year. So we're now switching to the phase of during the audit. And we recommend that you have frequent check-ins with the audit field staff to get an understanding of how the audit is progressing and to keep apprised of any issues that they have identified. You'll also want to get updates from the auditor on any outstanding items and any audit findings, such as any misstatements that have been identified. And this will give you an opportunity to review and confirm whether in fact the misstatements that they have identified are in fact misstatements. A weekly update may be more appropriate in the early stages of audit, but I would suggest more frequently as the audit nears completion. The treasurer or the finance committee chair should be informed about any significant matters that may arise during the audit, and they may also wish to receive updates on the audit progress, even if there are no significant matters to report. As your audit nears completion, Management normally meets with the auditor to discuss the draft financial statements and other deliverables that are typically also in draft format. There may be several versions of the draft financial statements before a final version is ready to present to the Finance Committee or the Board of Directors. So do remember to allow sufficient time for this process. The auditor will meet with the Finance Committee or the Board of Directors to discuss the draft financial statements and the results of the audit. But the Treasurer or the Finance Committee Chair may also wish to review the materials prior to the committee's or the board's review. So it's a good idea to build in some additional time for that. The auditors may also issue a management recommendations letter, sharing their insights into areas for improvement within your organization. This is a helpful management tool and an area where the organization can obtain value beyond the auditor's report. If your auditors don't provide a management recommendations letter, we recommend asking for one during your pre-audit meeting when you have that opportunity to set expectations. So do remember that it's not all over after the auditors have issued their report on the financial statements. Here are a few reminders for the wrap-up stage. It's important to record the auditor's adjusting journal entries and ensure that your accounting records align with the audited financial statements. To avoid other differences occurring, close the fiscal year in your accounting software when the trial balance has been provided to the auditor, and discuss any unrecorded transactions that may come to your attention after closing the books with your auditor so that you can agree on any transactions that you would both need to record. Ensure that you understand the auditor's adjusting entries and have received the supporting documentation for those entries. And also ensure that those entries are appropriately described in the accounting software. We recommend avoiding descriptions such as auditor AJE or auditor adjusting journal entry, and rather describing the nature of the entry, for example, depreciation of equipment for 2022. If your organization issues an annual report, which includes the audited financial statements or summarized audited financial statements, or otherwise refers to the audited financial statements, the auditors will need to receive a final draft of the report to ensure that the financial information in the auditor's report is accurately and completely included in the annual report, and to read through the other information in your annual report for consistency with their understanding of your organization. This requirement also applies if the financial statements are posted on the website. This is also a good time to review the auditor's performance. Think about whether your expectations were met and whether you received value for the fees that were paid. The directors or the members will also need to appoint an auditor for the subsequent year. And soon after the end of the audit is a good time to complete the review while these perspectives are still fresh in your mind. And this will allow ample time to prepare for an RFP process should you wish to issue an RFP. It's also important to plan the implementation of the auditor's recommendations and the management recommendations letter, and to do this early in your next fiscal year so that you get the maximum benefit for your organization. The next slide provides a helpful overview of the amount of time each phase is expected to take. The preparation of the audit and the audit field work typically take 2 to 4 weeks, with larger and more complex organizations being closer to 4 weeks. Finalizing the audit deliverables and attending meetings is normally in the range of 1 to 2 weeks, and the post-audit activities should take place as soon as possible after the audit has ended. The role of the Finance Committee and the Board of Directors is important to the audit process. And the next few slides cover some of the questions that they may ask of the auditor. So as part of their oversight responsibilities, they may be interested in whether the internal controls for financial reporting were adequate. If not, they would want to get an understanding of where they've fallen short and how they can be improved so that this doesn't recur. Having a sound understanding of the most material recommendations from the audit would also be of interest to them. Auditors often categorize their findings as material or significant or other, meaning that they're neither material nor significant. And this can help committees and boards focus on the key issues. They would also want to know whether there are any legal or regulatory issues or any other business risks that the auditors have identified that may impact the finances of the organization. They would want to know whether the auditors found the management team to be cooperative. And this is often discussed in an in-camera session with the auditors. They would also want to know whether any items could be disputed by the CRA or their funders. The committee of the board or the board would want to know of any areas in which the organization is not in compliance with any funding agreements and any other contractual arrangements, as well as income tax and indirect tax legislation. And then they would want to know whether management followed the recommendations from past audits. So if management chose not to implement any of the recommendations that were made by the auditors, committees and boards would be interested in knowing why they were not implemented. It would be also interesting for them to know how your organization compares with other not-for-profits, especially if they're operating in a similar sector to yours. And this is a great opportunity for boards to gain an industry insights, but of course without any confidential information being compromised. They would want to know whether you found anything that needs to be brought to the attention of the board. And this creates an opportunity for auditors to share any additional insights, including those that are related to governance matters. And they would want to know about any further suggestions that the auditors may have about ways to improve accounting, reporting, and operating procedures. This is particularly a helpful question to ask the auditors, and if they haven't actually issued a management recommendations letter. Now, of course, the committee or the board may actually ask the executive director or the director of finance certain questions. And this may include their level of satisfaction with the auditor that was chosen to conduct the audit. So you may want to consider the following. Was the auditor knowledgeable about your organization, the not-for-profit sector, and the accounting standards for not-for-profit organizations? Was the audit team well organized and respectful? And was there adequate continuity of staff? Did you notice or hear about any challenges or disputes among staff during the audit? And if so, what gave rise to these disputes? Was the presence of the auditor unduly disruptive to your regular operational activities? So well-organized audit should minimize disruptions to your activities. And with that, I'm going to hand back to Christine to take us through the remainder of the presentation.
Thank you, Shirley. That was fantastic. I just wanted to remind everyone that as we near the end of the webinar, we will be answering questions. So please, while you're listening, feel free to drop questions in the Q&A, and we will be addressing those right after we finalize the slides. Let's talk about year-end Canada Revenue Agency filings. You may need to file a corporate income tax return, also known as the T2. NPOs that are incorporated under federal or provincial legislation are generally exempt from corporate income tax, but must in most cases file a return. It's due 6 months after your year end, and no taxes are payable on surpluses or capital gains realized. The trust income tax and information return, also known as the T3, is required if you are providing dining, recreation, or sporting facilities. You're taxed on income from these activities, and you must file an annual T3 within 90 days of the calendar year end. The T1044 is the nonprofit information return. It is required if the following criteria are met. Your NPO received taxable dividends, interest, royalties, or rentals totaling more than $10,000. Your assets exceed $200,000 at the end of the preceding fiscal year. The NPO had to file a 1044 for the previous fiscal year. Then you'd have to file one again. And the 1044, the T1044, is due 6 months after your fiscal year end. Then we talk about the T3010 registered charity information return. CRA requires that the T3010 filing for every registered charity is filed every year. It must be filed annually to maintain charitable status, even if the organization is inactive. And CRA absolutely does action revocations if you do not file your T3010. It is due 6 months after your fiscal year end. So in order to keep your charitable status, it is imperative that this is filed every year. All right. Now we're going to turn the webinar over to you. We're going to address your questions. We're going to pick some questions. Time will likely not allow us to get to all of the questions. I see dozens of questions there. But between Shirley and I, we're going to be choosing some questions and addressing them. So Shirley, have you looked at any questions that you'd like to address?
Yes, I have. I see we've got many questions. I think time won't allow us to respond to each of these, but we'll certainly ensure that we provide responses to your questions that will be available to you at a later date. But Christine, I'm going to perhaps pose this first question to you. We use cash-based accounting. How does accrued liability impact this? Or can it be reflected on a cash basis of accounting? So I'm assuming here the question is, can financial statements be prepared on a cash basis of accounting?
So it can, and Shirley, you absolutely can help here as well. So you're choosing one or the other. So in accrual basis accounting, that's when we would accrue liabilities. That's a fantastic question. But if you are choosing cash basis accounting, then you would not be accruing. You would be using your bookkeeping to only record the transactions that are going through the bank at any given time. Do you have anything to add to that, Shirley?
Yes, I do. So I think firstly, you need to consider the basis for preparation, or the required basis for the preparation of your financial statements. So if you're using the accounting standards for not-for-profit organizations, you need to prepare your financial statements on an accrual basis. A cash basis of accounting would not be acceptable. But if, however, you are preparing financial statements perhaps to meet the terms of a funding arrangement that you have, and that funding arrangement requires that they be prepared on a cash basis, then of course you would prepare that information on a cash basis of accounting. Another good question here is, should charities, for example, churches, be concerned with a qualified opinion from the auditor? And is this to protect the auditor? That's a great question, because qualified opinions for not-for-profit organizations are not uncommon. And typically qualified opinions relate to the completeness of revenues and most notably donation revenues. So various organizations may collect donations from a variety of sources. Of course, many of them are increasingly digital these days, where there are donation buttons on websites, but at some events there may be, for example, perhaps a fundraising event that takes place where cash is collected, and auditors really struggle to be able to gain enough evidence to demonstrate that all of your contributions have been, your donations have been recorded. And so typically there is a qualified opinion in this respect. So if the concern here of the attendee is principally around the completeness of revenues, then I would say that this should not be a significant concern. Funding organizations, and I think the marketplace in general, is quite used to seeing these qualifications. However, if it does actually extend to other aspects of your financial statements, that could raise a concern.
I actually am going through, thank you, Shirley, going through some of the questions. There was a lot of questions, and I apologize for not mentioning what a PBC was in the beginning. So some people were sitting there saying, you know, talking about PBC. And so thankfully, Shirley addressed that in the webinar prepared by client. But there is one question related to the PBC list. When is it sent? So you can expect that prepared by client, and that's you, list, or your bookkeeper, as soon as the audit starts. So there is a schedule, and they'll say, okay, we're going to start, and it'll be a little bit before the audit. So if they've scheduled the audit, let's say for April 1st, then we would now be seeking a couple of weeks before. Shirley, do you see it usually? I think we usually see it about a couple of weeks before, sometimes even a month before they've got that list set up. But a lot of auditors are asking to see the books, and then they'll create the list from that. So it's right when you're done your pre-audit work that you give over your books to the auditor and they produce that PBC list. Shirley, would you agree?
Yes, I would agree with that. I would also encourage you to ask for a PBC list for an interim audit if you do have an interim audit done. So that would be in addition to the year-end audit. And I would actually ask for those PBC lists at least a month ahead of the start date for the audit, or the date by which the auditor has indicated they need the information.
Now I'm going to pass the question on to Shirley, because I've seen this asked a couple of times in a couple of different ways. Does the T3010 override the T1044, or does an organization need to file both? That's a combination of a couple of questions.
Right. Okay.
Great question.
They are two completely separate returns. So the T3010 applies if you are a charity. So if you do not have charity status, you would not complete a T3010. However, if you're a not-for-profit organization, you would file a T2, and typically you would also be filing a T1044. So you would just need to look and just keep up to date on the requirements for filing the T1044, because that does change.
And I've seen a question come in actually a couple of minutes ago. What should be the responsibilities of your bookkeeper on year-end preparation? So we see that as, we call it at Enkel, we call it a pre-audit. So we also do bookkeeping. And so we are looking to ensure, as Shirley was mentioning in the webinar, that everything that's on the balance sheet is ready to go to the auditor. It's reconciled, you have supporting documentation, you have supporting schedules. And so that onus should be on the bookkeeper. You should be able to ask your bookkeeper to provide all of the support for the entries during the year.
Yeah. Christina, I see another great question coming in here. Should
Okay.
the board review and approve the auditor's report and record the decision in the board meeting minutes, or just empower the CEO or the executive director and the treasurer to co-sign on behalf of the board, even if the board did not review and approve the report?
So what do you
So the board actually has a responsibility to review and approve the financial statements. And the financial statements, and it's typically on the statement of financial position, would be signed by two directors as indication of the approval by the board. I would not delegate that responsibility because it is actually I believe legally the responsibility of the board. And I would also ensure that that approval is documented in the minutes so that the board can actually demonstrate that it's fulfilled that responsibility.
Now, there is one question that came in. Someone had come in late and they're asking for a recording. And so this is a great segue for me to just quickly talk to you about not only the fact that you'll be getting a video of today, but you can also download our new guide, Revenue Recognition in Not-for-Profit Organizations. The link is here, but it's also going to be sent to you in the chat. It's going to be sent to you after this webinar. And we will also be addressing questions that we can't address today because of limited time. So we will continue to answer questions for as long as time allows. But if your question hasn't been answered, we will take every endeavor to answer those separately after the webinar.
Mm-hmm. Okay.
All right. Is there any other questions that have come in?
Yes, so there's, excuse me, another one. Would you expect the CAS 315 changes to incur significant additional cost? I would say that the increases we are seeing are somewhere in the 10 to 20% of your audit fees as an increase, of your previous year's audit fees as an increase. I sit on a number of boards of charities as well, and have been quite surprised to see the level of increase in these fees. So as I say, it's just the standard is really requiring a much deeper dive into that risk assessment process than what we've seen in the past. And this is really going to expand the amount of work that the auditors will be doing at the planning stages of their audit.
Mm-hmm.
Another question here that I thought was a good one: are non-profit organizations' financial records public knowledge? Are there any financials that are confidential? So if you are a registered charity, you would be able to find public information that is part of your T3010 that is available on the Charities Directorate site for the Government of Canada. There are certain elements to that return, such as the information and personal information related to your directors, that is not made available to the public, but they would be able to see your financial statements. I'm not aware of any other requirement for a not-for-profit organization that is not a charity to be made public.
I see a question here. Is it a reasonable expectation that the auditor log into your software to find the information they need? And what happens if they're not familiar with your software? So I would say that in most cases, and when I was working in public practice, we had the availability of all software. But if you're running into a situation where your auditor is not familiar with your software, they may ask you for the reports that they require as opposed to them going into the software. Would you agree, Shirley?
That's correct. We're actually seeing an increasing trend on auditors actually requesting access to the software. So of course, they should have read-only access and not to have the ability to make changes. And I think there are advantages to this because typically documents such as invoices, be it your vendor invoices or or they would have access to any invoices that your organizations are issuing. They would actually have access to that. So instead of asking you for it, they can actually go directly to the source. And so this would really cut down on your time spent supporting the audit. So there certainly are advantages to that.
As we are
Sure.
closing in on the hour mark, I would just like to remind everyone that you will receive a copy of the webinar recording by email tomorrow. And Christine and Shirley, we are happy to extend the session by 10 minutes if you are open to answering more questions.
Thanks, Mercedes.
Thank you.
I actually wanted to ask Shirley this question here. I think this is a great question because Shirley has been on a lot of NPO boards. And I think about that board perspective when we're looking at choosing our auditor. And so the question is, how often do you recommend that a nonprofit bring on a new auditor, Shirley? Or is it sufficient to just switch to a different individual at the same auditing firm? Are there any risks associated? Is there anything that you can think of that would make an organization want to switch auditors if everything's going well?
Right. I did want to just bring to your attention that there is auditor independence is actually very important, and something that has been looked at in recent years is the long association that an organization that's undergoing an audit may have with its auditor. And typically, one cannot have the same audit partner involved with an audit for an extended period of time. So what many audit firms are doing are switching audit partners over after a certain period of time. And that certainly does assist in addressing that issue around auditor independence. I would suggest that you just ensure that that is taking place. If you are satisfied with your audit firm, there's no compelling reason to make the switch. You really shouldn't feel that you need to. But often that fresh set of eyes does help. I was involved actually with an organization. I was on the board where we felt that we weren't really getting value beyond the audit, having had a long association with the auditor. So for example, we were no longer receiving a management recommendations letter, and we did decide to issue an RFP. And so there have been a number of benefits and some fresh insights coming from our new auditor. Some organizations have decided to issue an RFP after a certain number of years, and 5 years or a 3-year period is often a selected period. I've often found that 3 years passes very quickly. My leaning would be more towards a 5-year period if you wish to do that. And that also gives you a chance to do a check on the marketplace in relation to fees. And of course, we know that our world changes very quickly. And it's always good to be able to compare what different audit firms are able to offer you at different intervals. So those are just some of my thoughts for you to consider.
Thank you, Shirley. Now I am getting a notification that the link to the download for our guide will be fixed shortly. So I did see some comments that people were looking to click on there. So please try again in a few minutes. And with that, I think that do we have any more questions, Shirley, that you wanted to raise the last couple of minutes?
There's a question that's come in that I'll perhaps just take the opportunity to clarify. And this is, wouldn't the Treasurer Financial Office Committee have already prepared the financial statements and reviewed them with the board before these are audited? Or does the auditor work with the committee to revise the financial statements? So if we look at the stage before the audit has happened, what the finance team is typically involved in is preparing the financial preparing the financial information. In other words, ensuring that all of those year-end entries have been recorded in your books, and the trial balance is then ready to hand over to the auditor. The actual financial statements that are prepared under the accounting standards for not-for-profit organizations would normally be prepared perhaps during the early stages of the audit if they're being done by your finance team. The board would normally not see those financial statements until later in the process. They may, of course, have already reviewed a set of internal financial statements, but generally not the ones that are prepared under the accounting standards for not-for-profit organizations.
Yes, it was that terminology of financial statements, internal financial statements, or the audited financial statements. Yes. Thank you, Shirley. So I think that we are good to go to wrap up this webinar. We are so grateful that you have come to join us. Thank you for participating in the polls. Thank you for your questions. They're excellent questions. And we do hope, all of us at Enkel and Charity Village do hope that that initial poll of how stressed are you with your incoming audit, that your stress level has come down considerably with your knowledge and preparation. Preparation is key with auditing. Thank you so much for attending.
Thank you, Christine and Shirley, for such a great presentation. I would just like to remind everyone that you will receive a follow-up email tomorrow with a link to the webinar recording and the resources mentioned during the session. So please feel free to share this link with your colleagues. Just as a reminder, if we did not have a chance to answer your question, please feel free to reach out to Enkel. Their contact information is displayed on the screen and will be included in the follow-up resources. The email will also include a survey link, which you can fill out with your feedback on today's webinar. And you should see a survey link pop up right here in Zoom following the session as well. On behalf of Charity Village, thank you so much for joining us today, and I wish you all a wonderful rest of your day.